What's changed for you in the last couple of weeks after, let's call it, the chaos that we've witnessed?
Yeah, so I think what changed is the economic outlook. So I do think that all the financial news that we're dealing with over the past week, and it's just been a week, has changed the outlook. What I think the possibility of a soft landing is much less today. I think probability of a recession much higher. I do think that changes the Fed trajectory. But the one thing that we haven't talked about is inflation. So these Fed cuts have to occur only and if only inflation comes down to a level that makes them comfortable. And we're not there yet. So everyone's expecting that this shakeup will bring the economy down and inflation with it. But if that doesn't occur, then that is a whole different outlook, and that changes the entire trajectory of the Fed curve.
Dalip Singh, the chief global economist over at PGIM Fixed Income, came out and said the balance of risks have shifted. Your colleague, also the former markets chief at the New York Federal Reserve. I'm curious from your vantage point whether you see that reflected in your inflation expectations as well, to join with Bob Michael in saying that you could see the whole curve under 3% over the next year.
Yeah, I'm not convinced of that, actually. I still think there's a inflation in the system is much more embedded. I don't see us cutting rates to the same degree that we've witnessed before. I mean, I could be wrong around that, of course, but this all presupposes that inflation gets to 2% or below. But I think we're operating above that line, not below that line. And I think the ability for central bankers to actually make that aggressive move, cutting rates, we don't have that capacity today. And let's not forget, I thought at least we got the playbook from the ECB last week, where financial stability was a concern, but they put that on the side and they said monetary policy on the other side. I'm not convinced the Fed is going to have that quote unquote luxury that the ECB had, but still there's two tracks that they have to take, and they're battling each other.
Would you be more confident in risk or less confident if the Fed raised rates by 25 basis points on Wednesday?
I don't know. I think the pause is probably the best outcome for that. But I'm not in the camp where, what do they know that we don't know? So why did they cut? I'm not convinced that makes sense. So I think a pause is probably the appropriate response. I think raising rates acts tone deaf, and I think cutting rates acts too suspicious that there is something going on. So I'm hoping for a pause.
Greg, I'm with you when it comes to the economy. This idea that the Fed knows something we don't know, it's ridiculous, and they've proven that themselves. But when it comes to the financial system, to some extent, don't they know things right now that we don't?
Well, if they knew so much, maybe we wouldn't have the SVB problem and some other things, right? So let's not give them too much credit as far as that's concerned. But I do think that central bankers globally are really focused on contagion risk and making the system function. So you saw that with the swap lines. So I really believe that this is a very different response function out of the global central banking community than what we've seen in the past. So I think that matters a lot. So there's a clear, decisive view to make sure that we function globally from a financial stability standpoint. So that gives me a lot of comfort. Whether that translates into a different rate policy, that's the question on the table.
Hey, Greg.